So I had a dream last night. I was swimming in an ocean of orange soda. Turns out it was just a fantasy. But it seems the stock market bubble is a reality. If you're over 40 right now, that means you have lived through at least three epic financial bubbles: junk bonds in the 80s, tech stocks in the 90s, and the housing in the 2000s. The most obvious bubbles happen in stocks because the market gets top billing in both the financial media and the psyches of investors. For many who don't really know about the stock market bubble, a stock market bubble is a type of economic bubble taking place in stock markets when market participants drive stock prices above their value in relation to some system of stock valuation. Also, in an economic context, bubble refers to a situation where the price for something, an individual stock, a financial asset, or even an entire sector, market, or asset class exceeds its fundamental value by a large margin. Financial bubbles, aka asset bubbles, are economic bubbles fit into four basic categories: stock market bubbles, credit bubbles, and commodity bubbles. Everything has hit a brand new record high. The S&P 500 record high, the Dow record high, Bitcoin record high, real estate record high, and Nifty also broke its record high recently when people sold one of his pieces for $69 million. And even though we traditionally talk about normal people, investments like stocks and real estate and even extends throughout really rich people. Investments, trading cards for instance, have just set a brand new record fetching $4.6 million for a signed rookie card. A first edition box of Pokemon cards just sold for $408,000. Ferrari set the record at auction for the most expensive car sold online. A Rolex Daytona broke the record for $1.5 million. You get where I'm going with this? The hike in price has people wondering, how much bigger can this possibly go? Why is everything going up in value so much? How much is a new stimulus package going to boost prices even further? And most importantly, are we actually approaching the everything bubble when everything is selling for unbelievable amounts? I mean, even the McDonald's Hollow Pikachu sold at auction for $17,700. Well, let's find out if we are truly in a stock market bubble. Did you hear about the restaurant on the moon? I heard the food is good, but it has no atmosphere. In order to get an insight into the topic that get a good understanding of what's going on in the stock market, we need to go back to where it first began. That would be March 15th, 2020, the day the Federal Reserve lowered their benchmark interest rates down to 0% to stimulate the economy. Businesses were shutting down from the illness. There was a real concern of a complete financial meltdown as people were required to stay indoors, work from home, and watch lots of Netflix, YouTube videos, and do TikTok challenges to pass the time. Policymakers were also incredibly worried that if businesses were to shut down entirely, people would permanently lose their jobs, the markets would go down, retirement and savings would be lost, and we could enter a deflationary spiral into the next Great Depression as everyone just hoarded onto their existing cash. So, as a way to temporarily solve these problems, $1 trillion stimulus was put in place. Money was injected into the economy and interest rates were reduced to incentivize people and businesses to spend more money, thus helping the economy. This strategy worked almost exactly as expected, but long term, this strategy had a bit of an unintended consequence. Because of the abundance of money, low interest rates, and very favorable lending policies, we've seen skyrocketing growth across nearly every investment imaginable as prices keep getting pushed higher. But the question now that's getting brought up a lot is this a bubble, or is this just a new normal that we should all get used to? The answer is yes, it's a bubble. During the worst economic crisis of our lifetime, the stock market has seen some of the most rapid gains in history. Now, many people have attributed this strange behavior to special circumstances and a new kind of market and economy. In fact, there's a small percentage of investors that have seen this strange pattern a few times before. For instance, in the year 1993, a new technology called web browsers started gaining popularity around the world. Now, these web browsers allowed the average computer user to connect to the internet simply and straightforwardly for the first time in human history. And it was this technology that helped lead to the expansion of the internet and of the growth of computers throughout the 90s. And this growth was so massive that from 1990 to 1997, the computer ownership rate more than doubled from 15% to 35%. And from 1995 to 1999, the number of internet users grew from just 15 million to over 260 million. Essentially, investors could feel the wave of a new economy coming forward. I mean, with upstart companies like Amazon selling books over the internet and eBay selling almost anything else, investors became extremely excited at the prospects of a new type of economy. Now, if that wasn't enough, also during this time, we saw one of the biggest cuts to interest rates in history. From 1989 to 1993, interest rates fell from 9.8% to just 2.9%. And all this meant was that investors could access capital much easier than they could just 4 years prior. And the last cherry on top was that there was a significant tax reform in the year 1997, which cut taxes on capital gains. And it was these three factors that led to one of the craziest periods that the stock market has ever seen. So, let's put into perspective how crazy this period was. Normally, if you invest in the stock market, you can typically expect a 5 to 10% return per year. But if you were an average investor and started investing in the stock market in October of 1990, you would have seen an average rate of return of about 39% per year for the next 10 years. And if that wasn't enough, if you were to have invested heavily in the tech sector with an index like the NASDAQ, you would have seen an average return of about 111.8% per year from 1990 up until the year 2000, meaning that if you were to have invested $100,000 into the tech sector in 1990 and simply held your investments for about a decade, your portfolio would have been worth $1.1 million. But the thing is that this appreciation in the tech sector and the stock market as a whole wasn't really because there was an influx of new companies that were raking in billions of dollars of profits. It was mainly because there was an influx of new tech companies that got investors excited. But more importantly, there was an influx of new investment capital from the excitement of the new economy, along with low interest rates and tax cuts. So, now one of the general metrics used to tell you how overvalued the stock market is a metric called the P/E ratio. And what this does is it just compares the price of a stock to its earnings per share. Now, even though the value of the company is a lot more complex than a simple P/E ratio, this metric still is a good general indicator of determining if a stock is overvalued. So in 1990, the average P/E ratio of the S&P 500 index was about 15, which is pretty close to the average P/E ratio for the last several decades. But after the influx of new capital that just started flooding the stock market in the 1990s, the average P/E ratio on the S&P 500 jumped up to just over 30. All this means that the average company had doubled its value in relation to its earnings or profits from the year 1992 to the year 2000. And during this time, it was very common to hear stories through family and friends and through the mainstream news of people getting very interested in investing and even day trading in the stock market to try and take advantage of these insane stock market gains. You see, if you were to just search on Google for the popularity of a search term like stock market investing, you will see that there are more than double the amount of searches for stock market investing on a daily basis today than there were on average for the previous 8 years. But also when you think about how the United States cut interest rates to essentially 0% recently, how there were also major tax cuts in the last few years, happy ratios nearly doubled in the past 6 years. And now there's a belief from investors that we are likely to be living in a new kind of stock market. One can't help but draw at least some parallels between what happened in the 90s and what is happening today. However, it is worth mentioning that the market today is quite different from the market in the 1990s, in the sense that investors are looking to make money off of established companies this time around versus investors investing heavily into companies with no profits in the 1990s. It's funny how England doesn't have a kidney bank, but it does have a Liverpool. Anyway, plus, this time around, the Federal Reserve is doing everything it can to prevent the market from crashing. And in the 1990s, there was kind of a key reason why the market crashed in the first place. So basically, we are in the biggest stock market bubble because of inflation. And here's one of the best ways to know if we are living in a bubble right now or not. When there isn't a reasonable explanation as to why an asset is increasing in value at a much higher pace than normal, what that means is because you are in a bubble. I mean, in the 90s, we saw it in the stock market and mainly in the tech sector. In the 2000s, we saw it in the real estate market. And remember, in the 2000s, when it became significantly easier to get capital from banks and confidence in the real estate market was at an all-time high, real estate prices increased by over 35% from 2004 to 2007. And this wasn't because the average person got 35% richer or any other hard economic indicators backing up the 35% increase. It was because an asset bubble was being created. A more recent example was the Bitcoin bubble of 2017, where the price of Bitcoin increased by about 370% from September to January. And that is it for today, guys. I would also love to continue the discussion and have your thoughts about the stock market bubble down in the comments section. Also, if you want to stay up to date with all of my new videos coming out, then make sure you subscribe and hit that notification bell icon next to the subscription button. Turn on all the notifications, and that way you will be notified whenever a new video is released. Do have a great time. Till next time, bye. Bye.